Why staying in the game matters more than earning more. People talk about compound interest all the time. They show charts, they quote annual returns. They say things like, if you invest this much every month, you will have that much in 40 years. But most people still miss the real point. Compounding is not just about money, earning money. The real power of compounding is uninterrupted time. You can move slowly, you can have average years, you can even make mistakes, but you cannot get forced out of the game. That is why one of the deepest lessons from Charlie Munger's life is not simply earn more. It is this: survive long enough for compounding to work. Financial history is full of brilliant people who disappeared. They were not stupid. Many were highly educated, well-connected, and confident. But they used too much leverage, chased too much excitement, or believed they could predict the next turn of the market. Then the cycle changed, and many were gone. Look at the Great Depression in the 1930s. For many families, it was not a chart in an economics textbook. It was a middle-class father selling apples on the street. It was a family farm taken by the bank. It was decades of savings wiped out by one severe downturn. That generation learned a brutal lesson. Debt is not just a tool. Debt is an amplifier. In good times, it amplifies returns. In bad times, it amplifies destruction. Munger grew up close enough to that era to absorb its lessons deeply. Later in life, he and Buffett kept returning to one simple rule: do not do things that can take you out of the game. That sounds boring, it sounds defensive, it does not sound like the language of ambition, but it is exactly why they were still around when compounding became enormous. In the 1970s, the United States faced high inflation, oil shocks, and a brutal stock market. Many investors tried to trade every move. They bet on rebounds, they bet on cycles, they bet on their own cleverness. Munger's lesson was different. Being right once is not enough. You have to survive being wrong, survive recessions, survive bubbles, survive inflation, survive envy, and survive your own impulses. One correct prediction does not make you wealthy. Staying in the game through 10 different storms might. This is why Don't Lose Money is not about avoiding every temporary loss. It is about avoiding permanent, fatal loss. Of course, every investor will face losses. Prices move, businesses disappoint, markets panic, but there is a difference between a temporary paper loss and a fatal mistake. A temporary loss is uncomfortable. A fatal mistake removes your ability to keep playing. But fatal mistakes are not always dramatic. Sometimes they look normal. They look like a luxury car bought too early. They look like a house that stretches your budget too far. They look like a financial product you cannot explain. They look like a portfolio built from excitement instead of understanding. They look like too much money sitting idle for years, quietly losing purchasing power. These mistakes may not destroy you in one day, but they make your life heavier, they reduce your flexibility, they increase your need for everything to go right. And that is the real danger. A fragile life does not need a huge disaster to break. Sometimes it only needs one layoff, one market decline, one medical bill, one bad loan, or 1 year of poor judgment. Leverage can do that. Concentrated speculation can do that. Buying things you do not understand can do that. Needing liquidity at the wrong time can do that. Compounding is patient, but it is also unforgiving. It only helps people who remain financially alive. The strange thing is that human nature hates this lesson. Human nature loves speed. It loves the person who made 300% in a year. It loves the hot stock, the hot coin, the hot fund, the hot strategy. It loves screenshots, not decades. But the people constantly showing off huge short-term returns often disappear quietly when the cycle turns. Over the long run, the market does not reward drama. It rewards discipline, patience, and endurance. Munger himself also evolved early in their careers. Buffett and Munger looked at cheap stocks, cigar butt situations, and businesses that appeared statistically undervalued. Some worked, some were painful. Over time, they learned that cheap does not always mean good. A poor business at a cheap price can still be a trap. A great business at a fair price can sometimes be a far better long-term home for capital. That shift became clear in deals like See's Candies. At the time, paying up for a quality business looked expensive to many observers. But the real value was not just that year's profit. It was the brand, the pricing power, the customer habit, and the ability to produce cash year after year. That is another side of compounding. Sometimes after choosing well, the smartest action is to do nothing. But doing nothing is hard. It is hard because of envy. You may be doing fine. Your plan may be working. Your savings may be growing. Your investments may be reasonable. Then someone around you gets rich faster. Someone buys a new house. Someone talks about a stock that doubled. Someone claims they found the next big thing. Suddenly, your slow, rational plan feels inadequate. This is one of the most dangerous moments in personal finance. You stop asking, am I moving toward my goals? You start asking, why am I not ahead of them? Munger often criticized envy because it produces no real benefit. It makes you miserable when others win, reckless when others move faster, and blind to your own long-term plan. You're running a multi-decade marathon. Do not ruin it because someone else is sprinting for 100 meters. Another enemy is overconfidence. You read a few articles, you watch a few interviews, you hear a persuasive founder speak. Suddenly you think you understand an industry. Munger's approach was almost the opposite. He was comfortable saying, I don't know. He respected boundaries. He knew that not every opportunity was meant for him. That is not fear, that is professional discipline. Real investing is not about touching everything. It is about knowing which games you understand and which ones you should avoid. This brings us to a simple question. Do you see stocks as lottery tickets or as pieces of real businesses? A trader looks at price. An owner looks at the business. A short-term thinker asks, will this go up next week? A long-term thinker asks, will this business still produce cash 5, 10, or 20 years from now? That difference changes everything. Munger's philosophy can be summarized in 3 practical warnings. Stay away from excessive debt. Stay away from unnecessary drama. Stay away from people and situations that repeatedly produce bad judgment. Debt can force you to sell at the worst time. Drama consumes mental energy. Bad company can pull you into bad decisions. In 2008, many people did not fail because they failed to predict the crisis. They failed because they were too fragile when the crisis arrived. The survivors were not always the smartest forecasters. They were often the least overextended. That is the cold truth of compounding. It does not simply reward intelligence, it rewards restraint. There is another reason survival matters so much. For most people, financial fragility does not begin in the stock market. It begins in everyday life. If all your income depends on one job, one paycheck, and one employer, then your financial life is already fragile before you ever buy a stock. Hard work is valuable, but hard work alone does not protect you if every dollar is already promised to rent, debt, lifestyle, subscriptions, and monthly payments. This is why the structure of your cash flow matters. The goal is not only to earn more, the goal is to slowly make your life less dependent on one source of income. A raise can either make you freer or it can make your cage more expensive. If every increase in income becomes a permanent increase in spending, then even a high salary may not give you real security. You are earning more, but you are not becoming harder to break. And in the end, compounding does not help the person who looks successful. It helps the person who stays solvent long enough to let time work. So what should an ordinary person do? Do not borrow money you cannot repay. Do not buy things you do not understand. Do not destroy a long-term plan because of a short-term market move. Do not chase every exciting story. Do not let envy set your financial strategy. You do not need to be a genius. You do not need to catch every trend. You do not even need to beat the market every single year. You need to avoid the few mistakes that can end the game. After that, time can do much of the heavy lifting. If you can make fewer fatal errors than the people around you, compounding may quietly do the rest. Do not chase miracles. Do not worship shortcuts. Stay in the game long enough for patience to become powerful. Let time become your most loyal business partner.